How is everybody doing today?
Doing great,
Good.
buddy. How are you?
I'm good. I'm good. I'm glad to have an excuse to put a suit and tie on. I actually had a lunch meeting with the banker, so yeah, so you guys get to see me in something other than workout clothes.
Gonna say you look sharp.
Thank you, man. Thank you.
My pleasure.
Yeah, this non-compete is like, you sell your business and you expect to like it be great. It's fucking torture. It's like, you can have money, but where's the fun in that? It's like I don't know how people do it.
I'm currently
Hands-
working on a audit where we're tracking member transports. One of the challenges.
I don't know about that.
Your audio is bad, buddy.
Plus, your camera's off.
Yeah.
Anyhow, Patrick, I think we can get started with, I guess there's a lot
Yeah,
of
see?
different topics, right?
Yeah, so we touched on a bunch of different things. I mean, obviously I'm a little bit tepid on talking about multifamily. I think everybody knows my history, but basically I started buying 2010 or 11. I mean, I did deals leading up to the downturn, but started buying, really heavily in 2010. Bought about 14 billion worth of assets, sold them off. It was 80,000 units at the top. I've got about 20,000 units now. In 2023, I sold my property management company. And so part of that agreement was non-compete. Basically, I'll sit on my hands and not buy multifamily till the end of 2026. So retirement sucks, but I have been making like private investments. I've been doing some service businesses. That's why I talk about them a lot. And the stock market's done really well. So, it's been, it has not been all bad. But multifamily is my, you know, I've been in the housing business, I guess, since I was 19 years old. So I'm 46 now. So a long way. And honestly, flipping houses is not dissimilar to flipping an apartment complex. It's crazy. I used to drive around Atlanta on the weekends, whenever, and learn different areas and, look at open houses and things like that. And you can really do it on apartments. And the cool thing about apartments, I think if you look back the last 30 years, occupancy is 94%. It almost seems like if you look at it, you're like, well, what's wrong with this? It's fucking true. And single family homes, like, not a question if you can rent them, it's just how much. I was always shocked when I started buying single family homes, how everything rented. And I used to list them on Craigslist back in the day. So it's a great asset class. I'm definitely not poo-pooing on it. It's just I'm a little conflicted. One, the numbers are hard to make sense out of right now, and two, I've got this non-compete. So anyway, anybody have questions about how, like what how they're trying to make how people are making sense out of multifamily right now, or how you can make sense out of it?
Patrick, can you talk about the high interest rates that are due to mature for these big commercial syndicates? What are they going to do when, they have to refinance and the numbers don't make sense anymore? Are they forced to
Yeah.
sell?
Yeah, exactly. Okay, perfect. So yeah, like a $30 million deal, back, when I was doing deals at like 65% leverage. So a $30 million deal is like what, $7 million around there of equity. And, that was if you were doing that around 2018 to about 2020, you're okay. But if you got in 21, 22, so coming out of COVID, interest rates plummeted, so cap rates plummeted. And then the world started moving out of the gateway cities into Atlanta, Texas, all the Sunbelt markets that I was focused on. So it was like, property valuations essentially doubled, with the compression of cap rates, with rents going up to 10 to 12% without having to do anything, etc. So people poured into that. I mean, Blackstone and some of the smartest people in the world were the biggest buyers. I sold $1 billion portfolio to Blackstone, sub 3 cap. And so all those guys that bought, they bought with 5 year, 3 to 5 year floating rate debt. Nobody bought 7 to 10 year. That's bullshit if you hear it. Nobody buys 10 year fixed debt. You're not ever rewarded for buying fixed debt, because if you have, say it goes up in value in 3 to 5 years, if you have somebody coming up to you and say, okay, I'm going to pay you double what you paid it for to pay off that 10 year debt, there's a thing called a defeasance penalty. And it costs you a fortune. So nobody that knows what they're doing fixes, maybe if you're a family in New York that plans on owning a property for 100% or 100 years and blah, 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 but nobody in my shoes. So anyway, the people that sold or bought assets in 21, 22, they're going to be faced with the the problem of, okay, your assets now 20% to 30% down in value, no matter what Grant Cardone says. Okay. So instead of that 6 million, so assume that 6 million is wiped out. You're now going to have to bring a new $6 million to a deal. So you're essentially having to double down on a deal. The big boys can do it. So a lot of my limited partners are Blackstone, Carlyle, Goldman Sachs. We're having to make capital calls on some of this stuff, and it's no problem. They're putting up 95% of it. I'm putting up 5%. We're good. But the guys that syndicated out equity, the people like you see on Instagram that had no business doing deals, that a lot of them raised retail money, those people are fucked. And they don't have the ability to go back to their investors and say, oh, you haven't got returns in 5 years, but now give me extra money. That's not happening. So I do think they lose their deals. The best way to look for that stuff, you can get lists or call brokers like Newmark, CB Richard Ellis, etc., and look at who those lenders were. I've done it. So the lenders are like these out of nowhere debt funds that lent crazy. There's a company called Tides. Tides has like fucking debt funds that I've never even heard of that did like 80% of their portfolio. It wasn't like Freddie Mac, Fannie Mae. It was these, bridge loan lenders that are now stuck with this stuff. And so you can go down there and see, okay, Tides Equities, where'd they get their debt? You can pull these debt sheets and they have all all the coming due maturities and who the lenders are. And that's, unfortunately, there's a wave of capital that'll come in. Blackstone's got a $14 billion fund. Everybody's got a 14, billion plus dollar fund. I remember $1 billion funds were huge. Now it's like being a billionaire. But everybody's got capital. So the second these things hit the market, the same thing happened in 2009. Everybody's looking for distress, but the second something hits the market, the value gets pushed up because everybody wants it and they want to go back to their investment committee and say, oh, we bought this distressed. Well, so in a way, it's kind of like you just have to get there and kind of look for, deals that, I mean, the big funds are going to buy portfolios. They can't buy 200 or 300 unit deals. Certainly not anything smaller than that. So you have to be kind of targeting one-off deals that these big PE shops can't fuck with. And ideally you can get it off market. A good way to do it is actually, I mean, what I'm going to probably do when I get out of the non-compete is buy another management company. That way you get bird's eye seat at all these properties that are struggling, can't pay their mortgage, can't pay their property taxes, blah, blah, blah. And then you can kind of be on the front lines of trying to get those deals. And you can also potentially manage for the lenders, take back receiverships, all that stuff. So it's not easy. That's a lot of information to consume. But, that's where I see it. In the meantime, like the same thing's happening in shopping centers, office buildings, and industrial, you name it. And, what I've been trying to do since I do have a non-compete in multi, I've been looking at kind of niche asset classes. By the way, somebody sent me the RV homes, right? RV homes, manufactured housing, everybody thinks, and in a large part they are owned by like white trash guys and wife beaters and all that, but they're very lucrative deals, right? You're basically leasing the dirt to these people with a trailer. And, you know, if they don't pay you, buy. And there's just municipalities don't want any more of that shit. They don't, who the fuck wants to live next to a trailer park? No one. But these rednecks love it, and certain people love it, and, you know, and they make money. And so, you know, and by the way, like institutions buy that stuff now. It used to be so lowbrow, like kind of the apartment business, that they wouldn't touch it. And now they do, blah, blah, blah. But like, it's very hard for them to do these one-off deals. They're not buying 7, 8, $10 million deals. They just can't. If you have $1 billion equity fund,
My bad.
somebody's getting kicked off.
Guys,
If you have,
mute your mics, please.
if you have $1 billion fund, it makes no, you really are hamstrung into putting out $30 million plus in equity per deal. And so look at these scrappy little deals, you know, like that have cash flow. I'm never really going to advise somebody on doing anything that doesn't have cash flow. I've done them. I've done spec homes. There's nothing worse than when you have money going out and nothing coming in. And, you know, if you just have to have discipline to buy, you know, with cash flow, you know, or somebody's got to give you just, you know, ridiculous money to manage, and you get fees off of it, and they don't care about cash flow. But somehow you got to have something coming in on a monthly basis, I think, to make things worth your while. What else? Come on, Matt Joseph, you got something.
I blew you up on that RV park. Actually,
Oh, that was you. Okay,
yeah,
good deal.
I just bought it in North Carolina. And it's actually luxury RV. It's not the wife beater style.
Yeah, you said that.
You know, so and that's a macro trend because of baby boomers are retiring and they're downsizing. So what they're doing is they're going in these 500 to $1 million RVs, and they're going cross country, and they're parking in North Carolina, Texas. They're going all the parks, no taxes. They sold their houses for a couple $1 million, but you know, if you could buy 14 acres in the right location, you know, they're renting them for $1,500 to $3,500 a week. And then they end up staying if you could build a culture like the pickleball courts and all that stuff. So
Yeah, the notion of a bunch of guys in wife beaters playing pickleball was fucking hilarious.
it's
But I
not
guess
that.
that's, yeah.
No.
But no, I agree with that. Actually, I think it's a good business plan. And I would have never thought the RV, like people sell their houses and get in RVs, but it's fucking true. I mean, I've had several people that have worked for me that have, you know, retired, and they're like, we're getting an RV and going across. And I was like, what? But it's true. Like people do it. My buddy plays for the Buffalo Bills, and, you know, couple, you know, upper middle class.
Hey, Pat's muted. Snow, can you unmute Pat?
I got it. I'm not technology savvy, but I could do that. But anyway, people pull up to my buddies who plays for the Bills for his football games in these high-end RVs, and they're like, yeah, you know, they'll be there for 3 or 4 days and then go to Florida and all this shit. I mean, anyway, it's good business model.
Yeah.
Anybody else look it up? Go ahead.
I was
We
just gonna say,
actually,
sorry.
go ahead.
Yeah, my question is, so I'm in that world of non-institutional, but a little bit too big for the average person to do. And I've acquired about 10 properties where the cash flow is strong, and I have about 500 units. My question is, when do you get to that critical mass where, you know, you start scaling and you're plugging in, you know, you have your system set up for multi, like when did you hit that point where you went from like 500 to 2,500 units or, you know?
Yeah. Well, I always say, or to think back, I haven't really thought about that, but what I did first is I built that management company. And so, you know, that showed like scale, even though it wasn't like crazy numbers behind the scenes. But what happened for me, it wasn't necessarily by design, but I bought one property in outside Atlanta, and then I got that developer that sold me a deal had 4 properties under construction or just finished in Houston. I flew out there. He's like, pick one that you like or whatever, if you can buy it. And I said, I'll take all four. It was a longer story, but I put four under contract. They were like 7 caps. They were fucking no-brainers. Everybody said no, basically, and other than Starwood Capital, and they did it. And every time I did a deal, I did a press release, I did email blasts. I wanted everybody to know I was doing deals. So after I did that one, people, all these big private equity shops wanted to do business with me. I mean, and I had no college degree. I had kind of a checkered, I got arrested for stupid shit, DUIs and stupid shit. But and they kind of turned their nose up at that shit. But at the same time, it was like fear of missing out. They're like, what's this kid gonna do next? Um, I would advise you, if you have 10 deals, you can make it look like you have a decent portfolio. I would show that, and then I would just kind of say, hey, I'm scaling up. It's very hard to raise capital, unfortunately, until you have a deal. And so everybody's going to give you the same advice I just did. And I have been in your shoes, and I same fucking thing. And like during my non-compete, I'm meeting with guys that I used to do business with, big private equity shops, and they're like, okay, we can't wait till you have a live deal, like so finding bigger deals too. I mean, there's nothing wrong necessarily with high net worth capital if you can raise enough of it, and it doesn't drive you crazy. I mean, taking investor money, no matter what, will drive you crazy. I mean, I used to have a whole asset management team just to deal with private equity funds, and they would have weekly asset management calls. They beat the shit out of my guys. I'd have to call them and yell at them because they were being so rude to my people. Like they would have to do detailed spreadsheets. Whenever you're managing somebody else's money, it's never going to be completely easy. But the scale is, and the trade-off though is if you go and now you do a $500 million portfolio or 100 million, just the fees off that get you rich, right? Like, it's a 2 and 20 type model. Where if you do it, like you're doing it now, you can probably get more of the back end, but it's just slower, right? Like you don't get this big pop until 5 years down the road. You own more. It's like that. Do you want to be king or do you want to be rich? You can be small and own 100%, or you can be huge and own a smaller percentage, but make a lot more money. Anybody else? Let me pick
You
on somebody.
mentioned
Can I
earlier,
ask a
Pat.
question based on
Yeah, yeah.
what Alex was saying?
Yeah. Where you at? Where are you
I
from?
I'm from Central Jersey.
Okay, go.
I follow you. I love your model and how you operate and everything you do.
Thank you, man.
It's very admiring.
Thank you.
What Alex was saying, excuse me, based on from taking where people were struggling with covering debt and when deals would go into default. What's your opinion on taking bridge to fixed?
I, hmm. Again, I think it depends on what your ultimate goal is. A
Like,
lot of
is it
people
just
do.
survival mode? Are you,
So bridge to fixed debt, fixed rate or floating rate debt?
no, bridge to fixed.
It just depends on your object. Well, so like, I'm not a fan of fixed rate debt. I know a lot of people in New York that, are legacy type owners and things like that, that'll slap 50% fixed rate debt on there and, for 10 years.
Right.
It's very hard to do that in Sunbelt markets because they are very volatile. And most guys are either developers or value add guys where their business model, like my average hold period was 3.5 years. And so if you have fixed rate debt, one is either it's usually 7 to 10 year debt, but the defeasance, you probably know what a defeasance is, but
Yeah.
people go out and sell those fixed rate debts to interest rate buyers, to bond buyers that already have calculated in they're going to get 5 years of interest payments. Well, if you have to pay off that loan first, they have to go defease it. So there's a breakage fee and things like that, which,
Prepayment.
yeah, And so that's what I mean, I had some, we did do some on fixed rate, and we were like, had a gun to our head. We were like, damn, we could triple our money in some cases, but the defeasance, we were so early in the debt. It was like the defeasance, it was like eating up a third of our profit. So, bridge to fixed makes sense if you want to buy it, fix it up, refinance it, and continue to own it. You buy something in Maine and New York, and you want to be a long-term holder.
Yeah,
Guys make a lot of money too. Like you buy it, fix it, refinance, and then use those proceeds to go buy another deal and another deal and another deal and another deal. That's a good model. I
that's
just,
our model. We have generally a 10-year hold on most of our deals that we do.
well, yeah, then I mean, I think, look, if you're a 10-year buyer, I think you're foolish almost not to do fixed. But if I've always been 3 to 5 year buyer, that fixed really just, you're not getting enough benefit for having fixed rate debt. Especially like throughout, throughout the last 10, 15 years, debt did nothing but go like this, you know? But yeah, I think, do you guys fix it up? Do you guys buy with bridge and fix it up, or do you guys buy it destabilized and then put on fixed?
So, so it's with room for growth. We don't take, heavy risk. We don't take heavy value add. It's generally, somewhat stabilized, with room for improvement. For example, we just bought an office deal in North Jersey. We took over, the previous ownership had to sell because they had a REIT that was a partner with them, and the REIT told them either you give us X amount of money or you got to sell. They couldn't come up with that money. We came in, we brought it, we turned it around. We're making around 18% cash and cash this year as year
It's,
one.
you
It's
can't hate that,
phenomenal.
right?
No, it's a medical based tenant, it's cash flowing nicely. We took fixed debt on that and we got it at 6.25, 70/30 LTV.
That's
Um,
good. Where do
and
you
we
guys raise your equity?
in-house,
Yeah. Is your
in-house.
own capital?
With a few investors,
That's good. Good for
not
you.
we don't really shop around. We generally have, capital lined up when
Yeah.
we're signing a final PSA. Um, But what's interesting is on that fixed debt, we have a prepayment penalty, let's say 3, 2, 1, that we
Yeah.
negotiated with the buy down. And we plan on refining even with the penalty within the next rate cut or two, and still taking out a big chunk of capital from that
Yeah, I think
refi.
it's a math equation. You guys sound like you know what the fuck you're doing, right? Like if you can if you can model out paying the breakage fee, okay. I mean, I hate the idea of paying any type of breakage fee. I think these lenders make enough money, but
Oh, for
um,
sure.
it's look, you guys 18% cash on cash, you can pay a little bit of breakage fee, right?
Right.
Like,
So it's about $200,000 we figured out would be the prepayment on year two.
yeah, where I got smoked before is 10-year fucking fixed rate, right? So if you
Okay.
try to sell 3 years, the breakage fee is so high because you got 7-year rest, 321 or 322, whatever you said. If you don't have that much term left, 200 grand you can live with, you know? Um,
Sure. But I had a
uh,
lot of friends that also got hurt, when they did the floating because they didn't underwrite conservatively enough. And when the bank came and they did a strike or two, they were choking.
oh yeah. Well, like I bought everything I bought. I mean, I did buy some deals in 21 that I'm not proud of, but we bought interest rate caps on all that. Well, the problem is those rate caps only last for like 5 years. So you're either having to come back and buy new caps or pay down debt. So we've done a little both. It's a math problem, right? Like, okay, one's going to cost you one X and one's going to cost you the other. But we've done a little bit of both. But yeah, that's if you have that. Like we always underwrote conservative too. Like if we were buying at a 4 cap, we planned on exiting at a 5 cap. We always had that 1 point delta, where people started getting in trouble. And I think some of these people now, like, we never underwrote cap rate compression. We never even underwrite cap rates staying the same way. I mean, we always thought there was going to probably be some cap rate compression, but you can't really bet on it. So, and then same with interest rates. I mean, do I think interest rates are going to go down? Yeah. You know,
But
am
who
I gonna,
knows?
who fucking knows, right? Like
I mean,
Trump,
people come to me with like, and I'm like, do you have a crystal ball that I don't have? And they're like,
Trump, Trump could take a dump on the market tomorrow, and who knows, right? Like it's just, you know,
can't
Putin
bet on
could,
it.
huh?
You can't bet on it.
Can't fucking bet on it. But anyway,
Like
man, I
going to
could talk to you
casino.
all day. There's
Yeah,
smart guys,
Zane,
and yeah,
I was
we
gonna
got
say
to move it
Zane has
around. But
another
thank you, man.
question. We've got some questions in the chat too. Zane, if you want to unmute
Yeah,
yourself.
sure. Hi, Patrick. My name is Zane. It's very nice to meet you.
Nice to meet
Um,
you. Where are you
s-
at? Everybody, tell me where you're from, by the way.
I'm from DC, born and raised DC,
Cool,
DMV, and I'm up here in New York for school.
good deal.
So I've come up on a lot of cash recently, as a result of exiting some business ventures to Swisher International.
Good for you.
And I love real estate because not only for the tax benefits, but because it's such a cyclical industry and because there's a lot of inefficiencies. One of the other things I do is I trade in the market. And when you can exploit inefficiencies, I feel there's an opportunity to fix them and you can increase revenue. Um, so, what would you say are the best ways to solve inefficiencies within buying multifamily and managing multifamily as well?
Well, that's what I did. So I would target deals that were undermanaged. And for, you know, the way to identify that is a lot of people buy multi and run them so cheap. So sweep all the cash flow, not keep up the landscaping, not keep up the interior, you know, just, just bleed these deals. So that was a big thing. Like you can make money on literally, you know, and they teach this in single family homes, but improving curb appeal. That sounds so stupid, but you know, paint the property, you know, make the interiors, make the clubhouse look good, make the signage look good. Um, they don't have a good website. You don't like it was crazy. Like I would come in, I had like a template website. We drop that thing in by the like literally the day we close, and we would brand it and market it. Marketing, right, is a huge thing. You know, if you have like so there's just like little things, and then the value add we would do on, you know, you know, God, we would do little things like put laminate flooring in that looked like wood. And people would pay us like on $1,000 rents, like something like $100 more or something like that. And we were getting, so every dollar we invested in that property, you know, called on you know, renovations or whatever, we were getting 30% on that dollar. And so there's just a lot of, you know, I'd say common sense things you can do that, you know, the big boys know how to do it. But they're like the thing about real estate, it's so fragmented, especially the smaller you go down. You're up in New York, like these like two-story walk-ups or these like small mom and pop deals that have been owned by these families forever, you know, that now they die and they got to sell them, blah, blah, blah. Like there is so much inefficiency and fragmentation that you can take advantage of. Um, so, by the way, you're a smart young guy to be trading on the stock market and even know what you're talking about, dislocation and shit like that. Good for you.
Thank you. Thank you.
Yep.
Matt, there's some questions in the chat too, if you want to go over those, whichever you want to ask.
Yeah, I can't see it. Let's see here. I don't. Okay, chat. Let me see. Okay, if you're interested in joining Inner Circle here, no, that's not for me. Does it make sense to look at secondary Okay, Brett, does it make sense to look at secondary, tertiary markets that offer positive leverage on multi? Hell yes, absolutely. I mean, it's funny when I first started doing this, people considered Atlanta, Raleigh, North Carolina, Houston, Texas, secondary. And so I don't think those are probably the secondary markets you're talking about, but we crushed it too, doing deals in like Chattanooga, Tennessee, Charleston. Charleston back then it was a tiny market. Now it's huge. Savannah, Georgia, even like parts of the guy before was talking about North Carolina, like, like I don't know, take small parts of North Carolina. There's like little college towns. I think North Carolina has something like the most colleges in that state. Each one of these little shit-kicker cities has a university, it seems like. So those markets, that's another inefficiency. Big institutional buyers have a buy box. It has to be 300 units. It needs to be, and they call it Super Bowl cities. So think about it. Every city that's hosted Super Bowls or has an NFL team, like they're not going to buy a deal in, you know, you know, some smaller tertiary market. So those are good, especially if you can get positive leverage. I mean, a lot of, yeah, there's nothing wrong with that. I think they're good markets and good play. I've done a bunch of it. Um, Structuring deals today to balance risk and attract investor capital. Good question. So balance risk and attracting investor capital always comes down to it's got to be a good deal. I mean, it's got to be a good deal. You got to be able to explain it easily and, you know, don't fool yourself, right? Like if it's not cash flow positive because interest rates are too high, um, it's not a good deal. Sorry. Like it's just a tough time to do it. I think if the better your deal is, the more you'll balance risk. Like shitty deals make deals much more risky. If they're not cash flow positive, that's a lot more risky. If you're buying a deal, Warren Buffett calls it what's it called? Margin of safety. If you're buying a deal where your cash flow is covering you're spitting out positive cash flow. You're easily meeting your debt service. You're making distributions. That's a hell of a lot less riskier than buying a deal that's cash flow neutral or slightly worse and praying that interest rates go down or your rents go through the roof or you can cut expenses. Hopefully you can do all that stuff, but it's just much more riskier going in. It's like flipping land, they call that a pig that eats but doesn't shit. Maybe you can flip it immediately. Maybe you get stuck with it paying taxes on it and whatever else with no income. So find something that works from day one knocks both those out. What's your take on student housing? My buddy started Landmark Housing. He is worth 2 or 3 billion right now. Him and I started at the same time. I'm actually pretty jealous of him, although I did sleep with his wife before they were married. So I've got that in my back pocket. But they're the largest developer of student housing in the world, really. They've crushed it. I think they own, I mean, look, they own the market. They own that business. What I would do with student housing is the way he started was in Athens, University of Georgia, building like townhouses and shit like that to rent to students. I think, and I've done similar things. I did like a townhouse community up in Boone, North Carolina, where Appalachian State. So I think student housing is always attractive. You want to get as close to campus as you can. And I think you just got to go for niche style deals because the institutional style is probably so overpriced that it's going to be hard to make money. Luxury RV, did we already talk about that? I think that's good. Industrial market. So I've never done much on the industrial. Here's why I'm a little concerned about it is one, the tariffs, but two, like Snow, who's on this call. Like I was reading something about 3D printing. 3D printing could really fuck up industrial real estate. I mean, 3D printing is basically, I mean, I don't understand that well, but like you take the technology and you basically can build or manufacture product on demand. Like, so instead of having to bring and import screws and nails and things like that, they can do this on site. They take the design and they just, however they make it, but they make it cheap and, right away. They don't have to import that stuff, from China and other places. So that's kind of scary. I mean, the thing that people got excited about industrial was, okay, Amazon's going to continue to grow, e-commerce is going to continue to grow. All that's true. And so I think industrial is always going to have a place. Uh, I also think I'd be scared that Amazon eventually takes over as much as they need and doesn't need third party owners. And then I have looked into it. What happens is that space becomes obsolete pretty fast. So, I would look at stuff and they'd say, oh, the value add is, this bay is not big enough to fit, modern semi trucks or whatever. So you'd have to come in and it would be like functionally obsolete. So, I would be careful. I don't know it enough. It seems really easy. But like, again, when my non-compete started, I was like, okay, I'm just going to dive into industrial. How fucking hard could it be? And, it seems like you go broke quick. And who the fuck wants to own warehouses like in the middle of nowhere? I think that's tough for me. Let's see. Best way to reduce inefficiencies with buying and management real estate specifically. I think I asked to answer that. Having done the amount of volume you've done, what would you do at the same, and what would you do differently if you could choose any asset class? Multifamily is the one thing is you've got to go where the capital is. So if Blackstone came out tomorrow and said they wanted to buy X, I would probably try to figure out how to be an expert in X and source as much stuff for them that they couldn't source themselves. So they're looking at doing multi-billion-dollar deals to get scale, you know, figure out how to aggregate to sell them a multi-billion-dollar deal. But the capital is in multifamily. So I would do that again. I'm gonna do that again. And it's you just gotta look for your opening. Doing your first deal's the hardest. Doing the second one is not much easier. Doing the third gets a little easier. The fourth, the fifth, the sixth, because you have to be a salesman. To raise big capital, you have to be able to sell. You have to have a clear vision. And so you have to sell your own momentum and okay, hey, here's what we're doing. It's going fast, this, that, whatever, I'm going to get to 10,000 units and I'm going to do that. Like, that's how I did it. I mean, I always spoke with so much conviction because I felt it. Like, okay, we're going to go out. I was the first one to start raising my hand, I think, as far as an operator, a sponsor was start buying billion-dollar portfolios. Everybody thought I was fucking crazy, but I got them done. And like the momentum you can do and the scale you can do in multifamily just lends itself very well to getting rich. I don't know how to say it better than that. I mean, it's very hard to say, okay, I'm going to go roll up 20 shopping centers. I'm going to go buy 100 office buildings because there's not that much capital. It may be the best deal in the world, like this deal in New Jersey, but it's just hard to get 100 out of 100 investors to bite into that. There's a herd mentality, right? Like institutions don't want to do anything to get fired. Okay, so they want to do everything their competitors are doing, and right now they're honed in on multifamily, right? Like, and they want to do it in scale. So I I am probably going to buy another management company in 2027. I'm going to probably try to do it the same way. And it's hard for me not to give that advice to others. All right, I'm sick of just reading these. Somebody asked me
Patrick, on
something.
what you said about that office deal, to my defense, we don't have 100 investors. We're very selective on who we do take as an investor. Guys that are going to be calling off the hook, we don't want. It's more we credit who our investors are. So we make them accredited for to fit into our box.
No, you're fucking lucky though. You've got richer friends and family than I do, But what I'm talking about is more institutional groups like Blackstone, Carlisle. The reason is because they have gatekeepers that manage the actual pension fund money. So like Townsend, they're based in Cleveland, Ohio. these guys, the pension plan managers make like 150 grand a year. Those are the ones that give Blackstone and Carlisle all this money, pension plan, college endowments, all that shit. So they don't get paid enough to take risk. And so they are telling these guys, listen, go into conservative stuff. Don't go into multifamily. Well, why? Because everyone else is doing multifamily and we're not going to get fired for recommending it. Right now, it takes, it takes being able to take a little risk to buy office. Would you agree?
Yeah,
And, and,
most
and,
definitely.
and
It's a
understand.
it's the 4 letter word in Jersey.
Yeah, everywhere it is. And Jersey's probably better than most, but like that's where the opportunity tends to be. Like the higher you get rich by taking something that's deemed risky and figuring out how to make it not risky. And the problem is, you have to have very, very good investor group that trusts you. By the way, I've never seen a tighter investor group than Deal New Jersey. I went there for a
Oh
fundraiser one
yeah,
time. Fucking gold
they're
mine. Yeah,
they're as tight as
I
you
used
can't
to be
break into that.
No, not especially not a guy with the last name Carroll. I'm friends with the Carey family, and it's
Oh
like God,
sure, they're huge.
yeah, yeah, huge. But anyway, all right. I guess
All right,
I
Patrick,
let's
Hey,
take a couple
Pat.
more questions.
you
hi
mentioned
Yeah.
Pat.
a couple of things. You
Hey man.
said that you
Oh,
would acquire management property again and redo the process that you did. Can you break down that management process, what you're looking for when you go out to buy one? And two, on a 200 unit apartment plus, what are the numbers looking like for you to go, okay, that's a good buy for you personally? Obviously, there's different criteria for everybody to a degree, but today's 2027 and your handcuffs are free. What does Pat do? And how does he break it down?
okay, so the management company is okay. You get scale in the management business, 10,000 units or above. So I would be looking at 10,000 units or below because I mean, they're like these little service business. They don't make money. The guys that own or operate them pay themselves a salary. So, and it's not a ton of money. Like the first one I bought, I think had 300 grand in free cash flow. This is back in 2009. And I bought it at 3 times. So I bought it at 900 grand. What you really make money, the real benefit is this efficiencies. So imagine you buy, to your example, what I would buy is 200 or 300 units right now. I would look at where I could borrow at, which is probably what? Chime in, what do you think? What?
Where markets are right now, where rate?
Yeah. What is 6.5, 7?
I would say somewhere between 6 and 7 would make sense, but that means
Okay.
that you would be buying at a higher cap, correct?
For sure. I mean, the way I always did it was we'd go up the 10-year treasury. So the 10-year treasury is like what, four to 4.25 right now.
Yeah.
The old rule of real estate was you got to buy 1 basis point above that. So, but the problem is I don't think you can make money well, I think you can borrow less. You can borrow at less than 6.5 for floating rate debt right now. So, but I would just keep it simple. I would look at what I could borrow at for 65%. And if it cost me, and I had to put up, say, 10, $15 million, I would want 7 or 8% cash on cash. I mean, very simple. If I wanted a 10%, I put in 10 million and I get $1 million in cash a year. I mean, if you can get 4% on your money in cash or close to cash, which I do, I don't see the idea of taking the risk for much lower than a 7% cash on cash. And that's just personally. Like, and by the way, like everything I do personally, that's what I do for my investors. So I used to tell my investors, these little shitheads, that work at Goldman Sachs and whatever, when they would start giving me shit, I would say they'd be, oh, my money, we're putting $50 million in this, blah, blah, blah. And I'd be like, no, motherfucker, I am by far the largest individual investor. For your 50 million, I'm putting in 5 million of my own cash. You have little fucking institutions and blah, blah, blah. But if you peel back the curtains, you guys, as Goldman guys, have zero in this. So let's be real here. And so I was always big on that too. And how do you come up with that co-invest capital? I really, I would roll acquisition fees. Okay. I'm buying a $30 million deal. 1 point on that is a $300,000 act fee. I would roll that deal in. By the way, I would, instead of paying ordinary income on that, I would leave it in the deal. And it was for, we would classify it as an intangible contribution. So I'd leave that money in the deal. And when the deal sold, I'd probably double that plus pay capital gains on it. But that's really what you got to do to get going, right? If you can't stroke a co-invest check, make sure you don't tell your investors that. Make sure you get market rate fees and leave it in the deal. And even if you go to raise a fund, like I'm going to probably go out and raise a 250 to $500 million fund. I'm going to say, okay, I'll put up, because I'm now just coming back of this, that, whatever. I'll put up 10%, which is a lot. So if I put up 25 million, okay, I don't have to write a $25 million check the next day. Okay, if it's spread out over 10 deals, it's 2.5 million per deal. You start getting cash flow back, things like that. I roll some fees. And so that's how people do it. I mean, that's how you get really creative with financing and things like that, that you got to do.
I've been
Okay, so
saying this
that's
for
what
I've been saying this for so long, where I've personally invested as an LP into other people's deals to help them out to grow, to help people network. And I would look at their operating agreement, and they would have all these fees and all this thing, and then I would call them up and say, "Wait, how much capital are you putting in?" And they'll be like, "Oh, we're putting in our acquisition fee," and I'll be like,
I've
"I
done
don't
LP
know."
deals. I've done LP deals and I hate them. I hate them. I hate them. I hate them because I know the economics too. So plus, I get too tempted to reach over their shoulder. Okay. What
If you're a
else?
healthy syndicator, though, you generally can, like me as myself, we generally have that investor base where they understand and they trust, based on what we're doing, and we're not just putting in the acquisition fee, we're keeping it in the deal, like what you said, which a lot of people were making that mistake and taking it and just taking it out and doing whatever they want with it.
Good deal. Keith Moore, you look smart. What do you got?
What's up, Pat?
Hey, bud.
Hey, man, I'm a little guy. I'm over here in Orlando. I've done a lot of small deals, like single family home flips. I got a small portfolio of homes, all cash flow, whatever. But I've been trying to take it to the next step, right? And past couple years have been tough. I've been best and final several times. I've been trying to go after the institutional deals, but when we get in a best and final, we get beat out by the institutional guys every single time. So that said, man, what would you do moving forward to break into this market?
It's fucking tough, right? Like
It is. It's fucking tough.
everybody's got a fund. Everybody's got discretionary capital. I mean, you can get the broker laid, right? Like you can get him like the hot. No, I'm just kidding. Like you have to figure out a way, close faster, risk some hard money. Don't really, right? Like you have to do something. If there is Cortland Partners, who I hate, I used to compete with them, but if they're bidding on the deal too, if you are offering the same price, you're going to lose. So maybe you have to pay a little bit more. I mean, Harry Hemsley, who's one of the best real estate guys ever, there's a story of him. He was looking out the top floor of an office building at a dinner party. Somebody walked over to him and he said, "What are you looking at?" And he said, "I'm looking at my portfolio, like basically the whole city." And they said, "Well, how did you become so successful?" And he said, "Overpaying for everything." And so, I would always do that too a little bit. Like if I figured if it's a $30 million deal and it's me and five other guys willing to pay 30 million, well, maybe I'll pay 30, 30.2 or whatever, 30, I go up 200 grand because if it's not going to be good enough deal to make up 200 grand, then I lost anyway. So, you're not going to win dollar for dollar. So you just got to do something, to win that over. Right. And get really in the broker's eyes. And you got to convince that broker because he's going to be selling on your behalf to the seller. Right. Say I'm selling a deal or buying. Yeah. Selling a deal. I hired CB Richard Ellis or whoever, and they bring me a name brand group, and then they bring me you. And I say, okay, I've never heard of him before. Why are we going to go? Well, he's offered a little bit higher price. Okay, well, cool. Is he going to close? You have to convince him you're going to fucking close. And, it just, hey, Pat Carroll's my fucking equity partner. Like, we're going to fucking close or something like that. And that's what I would do. Like, I used to be like, I, I have Carlisle teed the fuck up. They're doing this deal. We're getting this done, right? Like, what's it going to take to get it done? And it's going to be frustrating, but there's no holy grail. That is the way you got to do it. I would say buy a lot of smaller deals or whatever. That's okay, but it's still not going to solve for that problem of when you want to do your first institutional quality deal. It's like you trying to pick up the hot girl at the bar. You got to just do what it takes for them to say yes. And that's the only way to really get in. But the game is, okay, I'll give you hard money. Well, hard money, you can kick the can on that for like 3, 4 weeks. You start having your lawyer draw up a contract. First of all, most of these sellers will give you a contract and say, this is what you've got to mark up. Have your lawyer drag that shit the fuck out. His first turn of the draft should look like somebody's red pen fucking blew up on that. All right. He should fucking, and just drag it out, drag it out, drag it out. By the way, behind the scenes, you are fucking scrambling, right? You are, because by the way, a deal that's actually tied up is a lot more attractive. Investors will take you seriously. Make sure that deal has a good story. Tell them how you got it. Hey, I agree to go hard quick, blah, blah, blah. If I drop this, Cortland's right behind me or somebody else is right behind me. Give them a little sense of urgency, and just like anything, make sure it's a good deal. People invest people get attracted to the deal more so than the sponsor. I wish I could say different. Like, I feel like, oh God, people love me so much they used to invest with me. If they didn't like the deals, they wouldn't have done it, so make sure the deal's fucking good, convince that broker because he's going to convince the seller. And that's the best advice I got.
Good stuff. Thanks, man.
Yeah. Let's see. What else, guys?
You guys can unmute yourselves.
Here's Matt. How are you?
I'm good, bud. How are you?
Good. My name's Matt, by the way. I'm from Long Island. I'm in West Palm now. Just a questions, kind of change of transition. I'm in basically doing a lot of wholesaling and innovations with my partner who owns the company. We're doing anywhere from like 20 to 30 deals a month. What is your outlook on kind of transitioning or having a commercial side of that and doing some wholesaling or innovations on the commercial side?
I think you can do it. I mean, do you guys let's see, you said wholesale, you're not renovate. Oh, you renovate them. Do you have construction
Sometimes,
in-house?
so we sometimes will hold some properties, but a lot of the times with these contracts, like last month we did 37. And it was one of our biggest months. Basically, we're replacing the contract and we're only putting about $100 EMD down. And then our title company is great. We go ahead and we're doing it. We're almost in every state except for really California. And we go ahead and we'll just toss the contract over. It's got to be off market. Then we'll go ahead. We get obviously negotiate a lower price. Then we go to our broker and then they'll list it on the MLS for a higher price. My vision is to go commercial because you're going to get bigger rips.
Totally. How are you tying up these deals that long? I mean, you're basically, you're tying them up and putting them on the MLS.
Yeah, so our contract states 45 days. Our average timeline is under 30
Wow.
because we're not super aggressive on the sell side. So like I did a deal in Oklahoma. I got it for 262. Our max available offering was 302. So I was able to negotiate it, and it was a 4,000 square foot cabin. So there was a 2,000 square foot cabin down the road that sold for 480. So we just went and undercut it and sold at 410.
So the answer is that's good, great, by the way. Like, you could definitely do it in commercial. The problem is the commercial market isn't as fluid as the MLS, and it usually takes longer to close a commercial deal. There is like some websites that have popped up you know, that like, I want to say you can buy notes and shit like that on, and I know those trade very fast. Uh, I would try to find somebody that deals. I mean, I hate to give them a plug because I think they're nerds too, but like Franklin Street in Tampa, somebody deals with like these sub institutional deals that has distressed buyers that are just clamoring. And, you know, you can get, like I said, a rip. I love that saying, but you can get a good rip on these because you know, you guys are doing the sweat equity, right? You guys are fucking moving faster. You're doing this, you're doing that. And you flip it to a fat fuck like Ben Mala who buys that kind of crap. And, you know, that's the play. And I think you just got to do a little bit of networking first to see who's your takeout, you know, who's buying those deals and what's the sweet spot. Like I'm sure you got a sweet spot on Resi, like, you know, okay, this is the bandwidth, this is the price point on deals, you know, such and such. I think you just got to get, you know, maybe it's $10 million plus. That sounds a little big. Maybe it's $2 to $5 million deals. I think if that's your business model, which is a great business model, the wholesaling and shit like that, because you're turning over money so fast, you know, you don't have to do massive deals. You're doing volume. It's almost like a mortgage business.
Yeah, that's I would say because I came from a syndication company in Long Island, and his, you know, he's been up for 9 years now, and his model was always obviously buy cheap off market, but he would stay middle market because the bigger guys can't touch it. So he would stay 5 to about 35 million, and he would find a bunch, especially on Long Island, industrial stuff like that. I mean, we closed an office property. It was 54% occupied. He got it for 3.2 million. Put 800 capex into it and just flipped it to a law firm for 7.65.
Attaboy. That works.
So, yeah, we would
I
probably
love y'all.
smaller to
Yeah, I
middle
love
market.
y'all. I got to be off in 2 minutes, 3 o'clock. So let me just, I was going to play with the AI thing, but I don't got time. We're going to keep doing these calls. One, they're fun for me too. I think hopefully you guys benefit from them. And, you know, we have these these group chats, whatever. Don't, don't be shy about giving me feedback on all that stuff too. My feelings won't get hurt. I want them to be productive and things like that, and I'm new to all this shit. So, you know, frankly, I never thought I'd be on social media. Second of all, I never thought I would be curating these types of groups or whatever, but I've had 1,000 employees for 20 years and I frankly miss this kind of shit. And so I like it. I want it to be successful and productive. So keep me, keep giving me feedback.